They call it a fair tax. I call it daylight robbery against every property owner in the country.
What if the home you worked years to buy became a monthly bill you can't stop paying? A new wave of property taxes is turning assets into liabilities, erasing equity, freezing sales, and squeezing families already battling inflation. Politicians brand it fairness, yet the numbers show collapsing returns, forced sell-offs, and neighborhoods sliding backward. Before another budget lands on your doorstep, see how this tax spreads, who profits, and the practical moves that could protect your future, starting right now. Number 1. Rising tax burden reduces net return. Property owners are facing a growing challenge as governments worldwide raise property taxes to balance public budgets. Over the last year alone, several countries, including the UK, Canada, and parts of the US, have increased local property levies by an average of 6 to 10%. This change directly eats into landlords and homeowners' profits. When the annual property tax bill rises faster than rent or property value, the net return on investment shrinks, leaving investors with less disposable income and reduced capital to reinvest. For small property owners or retirees who depend on rental income, these escalating taxes can transform profitable assets into financial liabilities almost overnight. The compounding effect of recurring tax increases makes the burden even heavier. For example, data from the UK Office for National Statistics shows that average council tax payments have doubled in some regions since 2010, while median wages and rental yields have not kept pace. This mismatch between earnings and taxation pressures forces many property owners to raise rents, reduce maintenance, or sell properties altogether. When too many owners offload assets at once, property prices can dip, reducing neighborhood values and eroding local market stability. Rising property taxes also discourage long-term investments in renovations and energy-efficient upgrades. Homeowners often delay improvements because their post-tax profits are too low to justify new spending. Over time, that neglect can reduce property quality and living standards, particularly in middle-income communities. For many, the escalating tax burden turns real estate, a traditionally stable form of wealth, into a risky, unpredictable investment. Policymakers argue that higher taxes fund essential services, but without balancing them against owners' ability to pay, they create a silent economic drain. The heavier this tax load becomes, the harder it is for property owners to sustain financial growth. Number 2. Property values may fall when taxes increase. When property taxes rise, market demand often drops because higher ownership costs scare off potential buyers. Real estate economists call this the tax capitalization effect, where increased taxes are quickly absorbed into lower property prices. For example, data from the National Association of Realtors in 2025 shows that every 1% rise in annual property tax can reduce property values by up to 3% in competitive housing markets. Buyers calculate the total cost of ownership, not just the purchase price, so higher recurring taxes make properties less attractive, especially to first-time buyers struggling with tight budgets and rising mortgage rates. This downward pressure creates a ripple effect across the entire housing market. When property values start to decline, homeowners lose equity, the difference between what they owe and what their property is worth. Negative equity can trap families in their homes, unable to refinance or sell without taking a loss. For investors, shrinking equity discourages further expansion, reduces collateral for loans, and can trigger forced sales in weaker markets. In cities where taxation policies shift rapidly, these trends amplify volatility, making it harder for both buyers and sellers to plan confidently. Over time, this cycle can damage whole communities. Falling values reduce municipal revenue, prompting governments to raise taxes even further, creating a feedback loop that punishes both property owners and local economies. Neighborhoods once seen as stable investments may face lower demand, declining infrastructure, and slower business growth. As a result, homeowners end up paying more for an asset that is worth less each year. The market's confidence erodes, turning property ownership from a path to wealth creation into a struggle for financial survival, fueled largely by aggressive tax policy and declining affordability. Number 3. Liquidity problems for owners with fixed income. For many property owners, especially retirees and small landlords, higher property taxes create serious liquidity challenges. These owners often rely on fixed or limited income sources such as pensions or stable rental returns. When annual tax bills rise sharply, it forces them to divert essential funds that were meant for daily living, healthcare, or savings. Unlike younger investors, they cannot easily offset these costs with new income streams or quick asset sales. A study by Bloomberg Housing Insights in early 2025 found that nearly 28% of elderly homeowners in high-tax regions struggle to pay property taxes on time, often resorting to loans or partial payments that accumulate over the years. Liquidity strain also limits the ability to maintain or upgrade properties. Repairs, energy efficiency upgrades, or safety improvements become secondary priorities when tax payments consume the majority of the available cash flow. This neglect can lead to physical deterioration of homes, making them less valuable and harder to sell in the long run. For rental owners, delayed maintenance directly affects tenant satisfaction, occupancy rates, and long-term profitability. Over several years, a high-tax environment creates a silent erosion of property standards across entire neighborhoods. The most dangerous effect of liquidity pressure appears when owners are forced into distress sales. Selling a property under financial stress often means accepting lower offers just to clear the tax burden. Some owners even risk foreclosure after missing repeated payments. This process not only wipes out years of savings, but also destabilizes local markets with sudden inventory surges. For fixed income groups, rising property taxes are not just a financial inconvenience, they represent a threat to security and independence, turning stable ownership into an ongoing struggle against compounding fiscal pressure.
Number 4. Higher taxes deter new investment and renovation. Property taxes have a powerful influence on where and how investors choose to spend their money. When tax rates rise sharply, the expected returns from new developments or renovation projects decline, discouraging both domestic and foreign investment. Recent 2025 data from the Financial Times highlights that cities with higher effective property tax rates, such as Toronto, London, and Los Angeles, have seen up to a 15% reduction in new building permits compared to the previous year. Developers respond to uncertainty by postponing or cancelling projects, which reduces housing supply and slows urban renewal. This ultimately creates a market imbalance that affects tenants, builders, and local economies simultaneously. The effect doesn't end with new construction. Homeowners planning renovations, expansions, or energy upgrades often rethink their decisions once they realize those improvements can push up their property's taxable value. That fear discourages modernization and sustainability-focused upgrades, especially among middle-income families. Instead of seeing property enhancement as a path to wealth and comfort, they begin to view it as an invitation for higher taxes. This mindset quietly suppresses innovation, architectural improvement, and green building practices, keeping communities stuck with outdated infrastructure. For investors, taxation is more than just an annual bill. It shapes the entire strategy behind buying, selling, and maintaining assets. When the post-tax yield becomes unattractive compared to other investment classes such as equities or bonds, capital naturally migrates away from real estate. Over time, this reduced inflow of funds limits local job creation in construction and services, slowing overall economic activity. High property taxes, when applied without stability or transparency, send a clear signal to investors: growth will cost you more than it's worth. That signal can freeze progress and drain vitality from once thriving housing markets.
Number 5. Tax expectations trigger precautionary behavior. Even before property taxes officially rise, the mere expectation of future increases can alter how owners and investors behave. This psychological response, known as precautionary behavior, often begins when governments announce potential fiscal reforms or hint at revaluations. According to a 2025 report by the OECD, regions where new property tax discussions were publicized saw a 9% slowdown in property listings and purchases within 6 months, long before any official changes took effect. Investors prefer to hold cash or redirect funds into less volatile assets until they understand the full impact of the new tax rules. This cautious stance reduces liquidity in the housing market and delays crucial investment cycles. For ordinary homeowners, the anticipation of higher taxes encourages extreme budget tightening. People begin cutting spending on maintenance, renovations, or even utilities to prepare for possible financial strain. This short-term survival mindset causes visible decline in property upkeep, especially in older housing sectors. Over time, widespread hesitation spreads through local economies as businesses related to construction, interior design, and real estate services experience reduced demand. The result is a slow yet tangible cooling of economic activity in property-dependent regions. On a macro level, these expectations can destabilize market confidence. Developers, sensing weaker buyer enthusiasm, delay launches or scale back projects, which reduces housing supply and drives prices upward for renters. This creates a paradox where fear of taxes, not the taxes themselves, disrupts affordability and investment. Once that uncertainty embeds itself into market sentiment, recovery becomes slower even if governments eventually soften their stance. Tax expectations therefore act like an invisible hand, suppressing growth, eroding optimism, and preventing both investors and homeowners from making decisions that could otherwise strengthen the real estate sector's long-term resilience.
Number 6. Uneven tax assessment creates unfair burden. One of the most damaging effects of modern property taxation lies in how inconsistently it is applied. Many cities use outdated valuation systems that fail to reflect real market conditions, meaning two similar properties can carry drastically different tax bills. The UK's Valuation Office Agency, for example, still relies on assessment data that in some cases predates 2015, while housing prices have shifted by more than 40% since then. This creates inequity, where long-term owners in booming neighborhoods pay far less than newer buyers in nearby streets. The result is a distorted sense of fairness and a tax system that penalizes the very people trying to enter the property market today. This uneven distribution doesn't just affect individual households, it reshapes entire communities. New homeowners or small investors often shoulder a heavier share of the tax load, leaving them with smaller margins and higher living costs. Over time, this dynamic widens the wealth gap between those who bought early and those struggling to establish themselves now. According to research from Bloomberg Economics, in 2025, regions with outdated assessment frameworks experience up to a 25% disparity in effective property tax rates within the same postal zone. Such imbalances discourage new entrants and reduce mobility in the housing market. Beyond financial strain, unfair taxation erodes trust in local governments. When people perceive the system as biased, compliance declines and resistance to future tax adjustments grows. Citizens become skeptical of reassessments and are less likely to support community initiatives financed by property levies. A fair taxation system should reflect transparency, consistency, and periodic reevaluation. Without those principles, property ownership turns into a contest of timing and luck rather than a stable, equitable investment, undermining the fundamental promise of fairness that taxation is meant to uphold.
Number 7. Tax changes can lock you into unwanted property. Frequent or unpredictable tax changes often trap property owners in situations where selling or moving becomes financially impossible. When taxes increase sharply, owners hesitate to sell because potential buyers calculate the new cost of ownership and offer significantly less. This phenomenon, known as the lock-in effect, limits flexibility and mobility across the housing market. According to a 2025 study by the Royal Institution of Chartered Surveyors, property transactions in high-tax districts of England fell by nearly 18% after recent council tax adjustments. Owners find themselves stuck with assets they no longer want or can afford, unable to liquidate without incurring heavy losses. For aging homeowners, this creates emotional and economic hardship. Many would prefer to downsize or relocate, but remain anchored to their properties because rising taxes and stagnant prices make moving unviable. Younger families face a similar problem from the opposite direction. They cannot upgrade to larger homes because existing owners are not selling. This stagnation reduces available supply, drives prices higher in low-tax regions, and deepens inequality between markets. Over time, tax-induced immobility weakens labor flexibility, as workers cannot relocate easily for better jobs, harming overall productivity and regional growth. Lock-in also discourages financial adaptation during personal or economic crises. When a property's carrying cost rises faster than income, selling should ideally be an escape route, yet tax structures often make that exit too costly. For investors, this means funds remain trapped in low-performing assets, preventing portfolio diversification. Governments may view higher property taxes as a revenue solution, but when the result is a market where people cannot move freely, spend confidently, or reallocate resources, it signals deeper economic inefficiency. Tax lock-in quietly transforms property ownership from an empowering asset into a restrictive burden.
Number 8. New taxes may reduce home ownership attractiveness. Rising and newly introduced property taxes are rapidly changing the perception of home ownership from a symbol of security to a financial liability. For decades, owning a home was considered a key step towards stability and generational wealth. However, 2025 data from the OECD shows that countries introducing new property levies, such as Canada's vacancy tax and parts of the UK's second home surcharge, have seen a sharp decline in first-time buyer applications by nearly 12%. Young professionals, already burdened by inflation and higher mortgage rates, view these taxes as another obstacle in an already expensive housing landscape. The dream of ownership is increasingly replaced by long-term renting as a safer, more flexible option. For middle-class families, these taxes often turn affordability into a moving target. Even if they manage to secure financing, the ongoing tax obligations reduce disposable income and increase long-term uncertainty. Every small percentage rise in annual property tax adds thousands in lifetime costs, shifting ownership from an investment to a continuous financial commitment. As these obligations grow, people delay major life decisions, such as marriage, children, or relocation, fearing the instability of unpredictable expenses. This behavior not only weakens individual financial growth, but also dampens wider consumer spending across the economy. The psychological impact is equally significant. When ownership feels punishing rather than rewarding, social motivation to invest in property declines. A market dominated by rental living and speculative investors erodes community cohesion, as residents feel less attached to neighborhoods they might soon leave. Over time, the erosion of ownership culture weakens the economic backbone that once supported local economies and generational wealth creation. New or rising property taxes, therefore, do more than reduce affordability. They quietly redefine what it means to build a future through ownership. Number 9. Regulatory and tax shocks create long-term wealth erosion. Sudden shifts in property tax laws or regulatory frameworks can destabilize years of accumulated wealth in a matter of months. These tax shocks often arrive with little warning, such as re-evaluation announcements, new levies on investment properties, or limits on deductions. In 2025, Bloomberg Real Estate Index data revealed that markets exposed to abrupt tax reforms experienced average home value drops of 6 to 8% within the first quarter following implementation.
Investors interpret such changes as a breach of financial predictability, leading them to pull back capital and redirect it toward more stable asset classes like bonds or digital securities. The loss of investor confidence cascades into reduced liquidity, lower property turnover, and declining overall market strength. For homeowners, this erosion manifests more quietly. As tax liabilities increase without proportional wage or rent growth, the value of long-term ownership diminishes. The real purchasing power of property equity weakens because a larger share of income must continuously service tax obligations. For multi-property owners, portfolio diversification becomes harder since they must allocate funds towards compliance, valuation appeals, and tax planning instead of reinvestment. Over several years, these cumulative effects slow personal wealth accumulation and widen the gap between property owners and non-owners. The broader economy also suffers from this instability. When property wealth declines, consumer confidence falls with it, curbing spending from everything from renovations to local services. Municipalities dependent on property revenue face budget shortfalls as transactions decline, forcing them to raise taxes further, deepening the cycle of erosion. Stable taxation builds confidence. Unpredictable taxation destroys it. Once trust in long-term property value is shaken, recovery requires not just lower taxes, but years of consistent policy to rebuild faith in real estate as a reliable store of wealth. Number 10. Local and global policy shifts increase uncertainty. Property ownership is increasingly affected by both local taxation rules and global economic policy shifts, creating a web of uncertainty that erodes confidence in real estate markets. Over the past year, international monetary tightening, environmental levies, and fiscal reforms have collided, reshaping the housing landscape. For example, the 2025 Global Housing Outlook by the IMF highlights how new green property taxes aimed at promoting energy efficiency have raised ownership costs by up to 4% in several European regions. At the same time, local governments in cities like London, Dubai, and Vancouver are adjusting foreign ownership taxes to control speculation. These overlapping layers of regulation make it difficult for investors and homeowners to predict future costs, discouraging long-term commitments. For local property owners, this uncertainty translates into hesitation and anxiety. Every new budget announcement carries the potential for another tax adjustment or valuation change, making financial planning almost impossible. Small investors who lack access to advanced advisory services are the most vulnerable to these policy shocks. Many are forced to maintain higher cash reserves or delay upgrades, simply to protect themselves from unexpected tax surges. This caution slows economic circulation, suppresses construction demand, and weakens job creation in related sectors such as materials, transport, and maintenance. On a global scale, interconnected markets mean that tax decisions in one major economy ripple outward. A sudden tightening of property rules in the UK or Canada can influence investor sentiment across Asia and the Middle East. Real estate, once considered the most dependable wealth anchor, now carries layers of geopolitical and fiscal risk. Without a coordinated approach to taxation, these policy swings create a volatile environment where even the most responsible property owners face unpredictable financial futures, undermining long-term confidence in global housing stability. The growing wave of property taxation is quietly reshaping the foundation of real estate ownership worldwide. What was once a stable and reliable investment is now burdened by unpredictable levies, falling values, and reduced liquidity. Each tax increase, whether through reassessment, surcharge, or policy reform, chips away at the confidence of both homeowners and investors. For millions, rising property taxes no longer just represent a civic duty, they have become a direct threat to financial independence and long-term security. If these trends continue unchecked, the dream of owning a home could shift from a mark of success to a symbol of economic vulnerability. As governments look for revenue solutions, the need for fairness, consistency, and transparency in property taxation has never been greater. A balanced system should encourage growth, not punish it. Property ownership should remain an achievable path to stability, not a risky financial gamble. If you found this breakdown helpful, hit like, subscribe, and turn on notifications for more deep dive analyses into global housing, taxation, and wealth trends. Comment below with your thoughts. Do you think property taxes are justified, or are they slowly destroying the middle class? Your opinion could be featured in the next video.